Hi team. Imagine that you have an opportunity to buy one of two businesses for the exact same price. In this hypothetical scenario, both companies generate $30 million of revenue, selling 1 million pool floats per year at a price of $30 each for an annual profit of $10 million. Financially, everything about these two businesses is identical apart from monthly sales volumes and the liquidity required to support these volumes. In other words, the primary discrepancy relates to seasonality. Seasonality can have a drastic impact on the amount of working capital required to run a business, which is why it is frequently cited as one of the primary revenue-related challenges in negotiating the working capital adjustment in a private equity transaction, which is also known as the working capital peg. To help this concept stick, in this post we will use visuals to explore how seasonality impacts the liquidity required to maintain a business. Starting with a high seasonality example. In the first example, we will assume that the business is located in Texas and that all of the company's customers are also located in Texas. Now, Texas is notoriously hot during the summer months, so it would be practical to assume that the company's sales ramp in anticipation of the heat and that sales peak sometime in summer. The management team of this company, being fully aware of the company's revenue cycle, significantly increases inventory purchases early in the year. By June of each year, this company has all of the inventory it will require for the summer season. During these summer months, sales increase, inventory sold off, and the company generates cash. The challenge is that such a ramp in working capital requires cash to accommodate both inventory purchases in advance of sales and the delay of cash receipts from accounts receivable. So let's update our chart to include cash. Now, it's obvious that the company made a profit selling pool floats because it has substantially more cash after the selling season. But what you will also notice is that the company nearly ran out of cash attempting to fund the growth of inventory and accounts receivable. Had sales spiked more abruptly, the $15 million cash balance that the company started the season with would have been insufficient. It's a little counterintuitive, but strong growth can bankrupt a company with positive net working capital, which is a very important lesson to keep in mind. Next, let's move on to the low seasonality example. If you were to take the exact same annual sales, but reduce the seasonality, the outcome is wildly different. So let's assume that the business was instead in a gorgeous location where people swim year-round, which probably looks something like this. It is in fact quite obvious from the chart that the amount of cash on the balance sheet is no longer necessary. In this new scenario, with the exact same number of units sold at precisely the same profit as before, cash does not drop below $11 million. To reiterate, in both scenarios, the company makes $10 million of profit selling 1 million pool floats at an average price of $30 each. But this low seasonality business, which clearly operates in a fantastic geography where people buy pool floats year-round, requires substantially less liquidity to achieve the same economic result. In fact, the highly seasonal business requires more than 3 times the amount of liquidity to make the same amount of profit. So which would you rather buy, and which would you rather launch as an entrepreneur? Let's start by answering the latter. As an entrepreneur, you would need $13 million to fund year 1 of operations in the highly seasonal scenario, and only $4 million to fund the business that makes an identical profit with less seasonality. The funding difference suggests that low seasonality is generally preferred. If you're wondering if I made these numbers up, I did not. Well, yes, they are fictional, but based on this highly detailed Excel workbook, which shows the debits and credits for the purchases of inventory, sales to customers, and accounts receivable collections. For a more detailed description, you can download the notes and work through this file if you feel so inclined. Now let's move on to our second question. Imagine that you are choosing which business to buy, and per the introduction, you can have either for the same price. Which would you take? Now, before we answer this, let's talk about ice cream for a moment. According to Lancaster University, a 1% increase in temperature results in a 1.2% rise in the demand for ice cream in the UK. So much like our beloved pool floats, rising temperatures boost sales. Unilever, which owns famous ice cream brands including Ben & Jerry's, Magnum, and Klondike, is aware of this and has launched a marketing effort pitching customers that it's always 20 degrees Celsius on your couch. For those of you unfamiliar with Celsius, 20 degrees Celsius just means warm in Fahrenheit. If they can convince humans to buy substantially more ice cream in winter, then they will have successfully reduced revenue lumpiness, and in addition, it might help them extract cash from the business. If you, in similar fashion, could identify a highly seasonal business and acquire it with an appropriate working capital adjustment, and then reduce the seasonality, you would see cash build on your balance sheet. And if you own the company, that cash balance is yours. Now, in this scenario, it would require Texans to swim in winter, and as a resident of Texas, I can tell you that is unlikely. But hopefully you get the idea. The way to get cash flow is working capital optimization. And if you identify an acquisition target and you believe you can run it more efficiently, the difference in liquidity is money in the bank after taxes. All right, team. Thanks for watching. That's all for now.